All right. Today is Sunday, the 10th of December. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. We begin this conversation where we left last week, the duality of the risk. Now, this is not a new phenomenon. Every time the Fed decides to raise interest rates and tighten the monetary policy to combat inflation, we always have the duality of the risk, that if they do too much, the economy could slip into a recession or something could blow up. And the other risk is if they do too little or declare mission accomplished a little too soon. By cutting rates, we could see the other risk of re-inflation. Case in point, back in the 1970s. Case in point, 2008, when we saw oil prices surging significantly higher after the Fed decided to cut rates in September 2007. But this period right now is the most critical period of them all, the landing. We're no longer planning or within the turbulence in the plane. We're now actually in the landing process, and the margin of error is really slim. Any mistake, you could face the duality of the risk, and this is why the phenomenon of soft landing never really happened before. Of course, they say that the 1990s was an example of soft landing, but again, go back to the history book, you'll find out that 1990s, there was no bubble. So by definition, there is no soft landing. In every other case, the soft landing mission failed. We either got a recession or reinflation, and later on, we got a recession. Why do we see this? Why do we see this all the time? Even though we are in a period right now called the light of the end of the tunnel syndrome, where we can at least speculate that we have a soft landing without understanding what the lag impacts of the Federal Reserve policy would do to economic growth and the jobs market. But in reality, the dirty secret here that nobody wants to talk about is when the Fed raises rates, they're not really fighting inflation. They're fighting excess growth in the economy, which means by definition, a soft landing requires a recession, but without anything major blowing up. A soft recession, if you'd like. But this is the dirty secret that nobody wants to talk about. Everybody believes in the fantasy right now that you could say mission accomplished, cut rates, inflation goes down, growth comes back up, and everybody lives happily ever after. Here's the problem though. When the Fed and the federal government decided to issue the tsunami of liquidity in response to the pandemic, what they've done is flood the system with a lot of liquidity that caused excess growth in the economy. Now, the natural remedy of excess growth in the economy is the phenomenon we call inflation. And the job of inflation is to get rid of excess growth in the economy. So the question now becomes, why don't we just let inflation take care of excess growth in the economy? And we don't have to do anything here, because we know from history that when inflation rises higher, it becomes embedded in expectations in the economy. And it leads to a phenomenon called runaway inflation, where inflation keeps going higher and higher and higher. And at some point, we see huge devaluation of the currency. Case in point, Venezuela, Zimbabwe, Turkey, Argentina. You see it all over the place. So we learned from history that instead of letting inflation do the job, the Federal Reserve or any central bank has to say, okay, boss, I got it here. Step aside inflation, I got it. I'm going to reduce excess growth in the economy by increasing interest rates higher. So we see when the Fed raises rates, inflation goes away, not because the Fed is fighting inflation. The Fed is fighting growth that caused inflation to be born. And as the Fed raises interest rates, we see that inflation keeps going down. We also see some damage to growth. Naturally, growth goes down. And at some point, as the Fed pauses and keeps interest rates as is, we see more damage to inflation, but we see growth recovering a little bit because of the expectations that the inflation problem is now behind us, and the next step by the Fed will be cutting rates. And now we can go back to growth with no higher rates without inflation. The problem is usually the underlying causes behind excess growth are not removed. And the moment the Fed cuts rates prematurely, what happens is we see growth going back higher, and then soon enough inflation follows, because this is the natural remedy for excess growth in the economy. And then the Fed has to play catch up again, raising rates to tackle inflation down. But this process has already caused severe damage in the economy. Years of inflation, years of higher rates. Certain sectors of the economy become weak. In the case of the Great Recession, we had the housing market. Now the weakest link in the economy is the banking sector and commercial real estate, along with the mountain of debt that has to be refinanced at a higher rate. This mountain of debt has been accumulated since the quantitative easing policy by the Federal Reserve been initiated. So we go back to the situation that we have right now. Interest rates by the Fed high, growth is now a little above average, nothing excessive really, and inflation has been tamed. What is the next step by the Fed? We talked about how they cut rates prematurely. That will bring inflation back, and that is a recipe for disaster, as we've seen back in the GFC and many other examples in the past. But with the market right now, and a lot of folks are assuming in their soft landing narrative, is that the Fed will cut and inflation will keep going down, growth will come back. Again, it's a fantasy that the Federal Reserve itself disagrees with, even though they keep selling us the hopium that we're going to have a soft landing. But the Fed is not stupid. They know, and they've been saying to us over and over and over again that this is not going to be the case. But of course, we have the tendency of fighting the Fed, specifically after years of lost credibility by this organization. The most likely scenario is the Fed will keep rates higher and keep watching inflation going down closer to their Fed target of 2%. And of course, they told us numerous times that they don't mind and would actually love to see below average growth, which means severe slowdown in the economy. This is not a secret. They told us this before. But we keep ignoring it because at the end of the day, the initiative behind raising rates is not to tackle inflation. Inflation is a symptom of the problem. The problem is the excessive growth and the underlying conditions that cause the excessive growth. And this is why the Fed will be extremely careful not to cut rates before they see growth slowing down dramatically below average, causing a mild recession, but not causing a severe one or causing anything in the financial system to blow up. That is the true definition of a soft landing, a mild recession, going back to the inflation target by the Fed, and interest rates actually not going down to zero. They stay positive, but lower than the interest rates that caused the tightening. And little by little, we see that growth in the economy being restored, going a little above average, nothing crazy, and that's how we know that the soft landing has been accomplished. The problem is, usually, once again, something goes wrong in this process. The lag impacts from higher rates catch up. And since we talked about one part of the dual risk, which is if the Fed cuts rates too soon, inflation comes back to remedy the resurgence of growth in the economy. But the other risk is, and usually this is what happens, the lag impacts catch up and growth, instead of being below average amicably, causing the mild recession and the soft landing, we see something going wrong in the economy. Bank blow-ups, sectors blowing up, contagion becomes to take over financial markets. We see growth dropping down dramatically below average. We see inflation also collapsing, in most cases into deflation territory, where inflation goes negative. And then the Fed cuts rates. So any observer, any investor, anybody who wants a good outcome for the economy, you better hope that we're not going to get rate cuts, severe ones, right off the gate. You better hope that these rate cuts will come as far and as late as we can, because then it means that the economy is holding up. Otherwise, a rate cut means that something wrong is happening in the economy. Now, the other risk is, even after we get a crisis of that sort, of growth blowing up because we have a sector of the economy blowing up, such as housing back then, and this time around could be commercial real estate, could be banking. The problem is we also have underlying factors behind inflation: nationalism, deglobalization, climate change, lack of resources, green energy. We talked about this before. That could bring back inflation even as the economy stays weak, just because the Fed cut rates. We could see the phenomenon of higher inflation and lower growth for years to come. That is a possibility, but that's after the fact. That is not the risk that we have right now. The risk that we have right now is the dual risk, that the lag impacts catch up with us. We dip into a recession, then the Fed cut rates to remedy that. The other risk is the Fed cuts too soon, inflation comes back. So here's where we stand right now. Inflation went down, Fed rates are higher, they're staying higher. Growth is a little above average. Nothing crazy here, but still average. So you look at this, and how could you not believe in the soft landing? How could you not believe that mission accomplished, we're done here? Inflation is going down to the 2%, growth is holding pretty good. Next thing you know, the Fed will cut rates, and boom, we're going to live happily ever after. What could cause the economy from moving from this picture right here, this hope, this dream, into the dual risk territory? In the case of a recession, say the Fed holds, they don't see the incentive of cutting rates because they're worried about the resurgence of inflation. The problem with that is, number one, and these are the main ones, we have many other factors. but we're just going to talk about the main ones here. Debt maturities under higher rates. Those could blow up, and they cause the Fed to cut rates severely to remedy the economic crisis. If we look at the year 23, believe it or not, maturities, be it in levered loans, high yields, investment grade, were relatively low. But as we get to 24 and 25 and beyond, we start to see more and more corporate debt maturing. Now, corporate debt is usually not the problem here. The problem will probably come from junk debt. And as you can see in 23, we had pretty much none, no maturities. But as we head to 24, those maturities will increase, not just in the US, but also across the Atlantic and Europe. As we head to 25, 26, 27, more and more maturities will begin to show up. If you look at US speculative grade, non-financial corporate maturities, rated B- or B and above, you can see that we have more maturities in 24, 25, so we're going to have to face refinancing an enormous amount of debt, some of them really risky, and the higher rates if the Fed holds. If we look at non-financials, be it investment grade or speculative grade, once again in 24, we have more maturities than 23. And of course, when we talk about maturities and refinancing loans, the biggest problem comes from the real estate sector. And now we're seeing delinquency rates moving higher, be it in lodging, office REITs, retail properties. Those have been higher when it comes to delinquencies, and they've been higher for a long time. Those are going to be under severe risk as the time for refinancing approaches. Industrials remains the strongest sector here when it comes to delinquencies. But you get the picture here, that we have stress in the system right now, but we haven't seen the full picture yet because the lag impacts of raising rates haven't been yet realized, and it is premature to say that we have a soft landing without seeing the full impact of what we've done already. When you look at global companies, Middle East, Africa, Europe, we can see more and more refinancing. So you see in second half of 23, we have a little under 400 billion euros worth of refinancing. In the first half of 24, we have over €500 billion in refinancing. Do you know if these companies will be able to refinance at a higher rate? Number one. Do you know what the exposure, the real exposure of the banking system, these bad loans that would default or have a hard time to refinance at a higher rate? We don't know the true picture yet. As Buffett says, when the tide goes, we know who's been swimming naked. But we haven't seen that yet. Also in the recession risk, again, if the Fed holds at this point, is consumer debt restricting spending. That could tip the economy into a recession. So when we look at consumer sentiment, it's been low for a while. Now it's been improving lately as we see the market going higher and inflation going down. So we see consumer sentiment improving, but it remains weak as we've seen since 2006 into 2008. We saw improvements here and there, but that did not really help, did not get us out of the hole just because consumer sentiment improved for one reading. The reality is, after a couple of years of inflation, really high inflation and higher rates, we see credit card debt in the U.S. skyrocketing to over $1 trillion. We see delinquency rates, 90 days plus worth of delinquencies, rising among credit cards, mortgages, auto loans, and soon enough in student loans. As we see the resumption of payments for student loans, that's going to be another contracting factor of the economy. And again, years of inflation, years of higher rates have eroded real liquid assets among most Americans. The bottom 40% of Americans by income, their real assets have collapsed. How are they going to stimulate the economy? When we talk about soft landing and everything's going to be great and growth will come back with no inflation, how would they stimulate the economy? These are the majority of spenders here. The 1% alone will not be able to hold the economy. You need the bottom 40 to participate in the economy, and now they're severely damaged. Higher rates for longer will definitely cause restriction in spending, which means corporate earnings will go down, which means that the economy will slow down dramatically. Combined with higher maturities, we could see a really undesirable scenario for recession being a systemic risk. Likewise, if the Fed decides to hold right now, tighter credit conditions could restrict lending in the economy. So you see already that we have tightening standards, the highest since the recession of 2020. And if this continues, we'll go back to the same levels of the recession of 2020 and the Great Recession in 2008 and even the recession in the early 2000s. When we look at credit conditions all in all, we are now at the lowest levels here since the recession of 2020, lower than credit conditions back during the GFC. When we look at bank loan growth, it has been collapsing. Commercial and industrial real estate, residential, consumer loans, all been trending down. And the demand for loans continues to go down. Current, future loan demand continues to go down. In other words, investment in the economy will slow down dramatically. Small businesses, corporate investments, individual investments. what will stimulate the economy if we have lending conditions and investment in the economy also going down. I see these as the top 3 risks when we talk about the recession risk if the Fed decides to hold at this point. Now, the other risk of reinflation, which is, of course, if the Fed cuts rates, specifically if it happens in a premature way, and sometimes you don't really have a good choice. In the case of 2007-2008, the Fed decided to cut rates knowing that there is a reinflation risk, but they had to do so because the economy was getting tremendously weaker. In the risk of reinflation, we have fiscal spending. That's not going to stop. So the Fed, if they cut rates right off the gate, we're going to see fiscal spending stimulating higher growth, above average, perhaps to excess levels. We will see the resurgence of inflation again. Spending for 24 for almost all categories will be higher than 23 and 22. The wealth effect, when the stock market goes higher, when we have real estate valuations going higher, the consumer still feels that they're wealthy enough to take risks, spend more, and that causes inflation to go back up higher, specifically if they get the impression that interest rates are going down. In the longer horizon, of course, green energy is a problem. The investments for the green energy infrastructure, A, requires more spending, B, it adds demand pressure on scarce resources, and that's also inflationary. If the Fed cuts rates in a premature way, we could see more demand for loans again to invest in green energy, and that would bring back the reinflation risk. But perhaps the number one problem for the reinflation risk is the aggregate demand. And the best illustration for that is the real estate market. So you can go back in the GFC episode, for example. The Fed began raising rates to tame the really hot housing market. So we saw pending home sales collapsing. When the Fed decided to cut rates in September 2007, we began to see that pending home sales moved higher again. And what we see right now is, since the Fed began raising interest rates, pending home sales collapsed. The real estate sector responds quicker than any sector of the economy to the Fed's policy. The lag impact is pretty much non-existent here, and the reason is mortgage rates. The simple reason here, folks, that inflation is not going to be defeated. It's going to require an economic crisis to get inflation out of the system is the aggregate demand in the housing market. Folks are now conditioned that they have 8% mortgage rates, 7%. If the Fed cuts rates, mortgage rates go down to 5%, 4.5%. Well, guess what? The aggregate demand will come back. Folks still have their jobs. They did not lose their jobs. The Fed is now cutting rates. Pricing is probably coming back up higher again, and we will see the chase by the consumer seeking, quote, affordable, end quote, housing, just because mortgage rates went down from the perceived higher rate that we've been conditioned to. Think about it this way. You've been looking to buy a home. You have a good job, great pay, you've been saving perhaps, but you're waiting for better rates. You're waiting for better prices. You see the 8% rate, you see the 7% rate. If rates go down to 4.5%, and then you see pricing going back up higher again, what would you do? You're going to panic and buy the home right away while you can still get it for a cheaper price. As you anticipate, prices will go higher and perhaps rates will go higher at some point later on. And this is probably the clearest reason for why the Fed shouldn't cut rates. And if they do cut rates right now, they will reignite the mania, inflation will come back, and they will have to catch up again. And in the past crisis, in the GFC, the epicenter, at least one of them, was the city of Las Vegas. And I believe this time around we see Las Vegas is one of the epicenters for the housing mania and probably the housing crash. You look at the city just from space here. It is surrounded by mountains. East, west, north, south. There are physical limitations of the expansion of this city. And as more and more people flow in, at some point the city will run out of space. And that's going to increase home prices more and more and more. You look at the supply of homes in Las Vegas Metro. It's been trending down. Only when we have recession risks, such as in 22, heading into 23, when we saw the supply rising higher. But it is still way short of demand. You look at the price of homes, it's not going down. It dipped down a little bit when we saw supply moving in higher, as we saw some recession fears showing up in the economy. But now we have recovered. And who's to say that if mortgage rates go down, we're not going to see demand also moving back up higher, and pricing will advance higher in the year 21 and 23. We see the share of homes sold above the list price also recovering in the year 23. And the mere perception that the Fed is done with raising rates and about to cut. Can you imagine what will happen if the Fed actually cuts rates? We'll look at the Case-Shiller Home Price Index. We see also a rebound in home prices across most cities in America, based on the mere perception that the Fed is done, the Fed will cut rates, they're not going to raise rates anymore. The ugly truth is, folks, how do you break this cycle? How do you get inflation under control? What they're not going to tell you is you need to see the unemployment rate moving higher in the economy. Historically speaking, Every recession was remedied by higher unemployment rate. We go back to the Phillips curve. Of course, there's a fantasy of the Phillips curve that a low unemployment rate causes inflation. That's false. We had periods of really low unemployment and we did not get inflation. But once you have inflation, you can't break the cycle here without increasing the unemployment rate higher. This is historically proven. And I think the Fed knows that, but I think that the majority of folks in the economy, the pundits, the analysts, the talking heads, the market, they don't realize it yet, even though they've been in it before. They've experienced all of this before, but they pretend that they don't remember at all. Or this time it's going to be different. That's a conflict of interest because they have to keep you invested in real estate, in the market. That's how they make their bread and butter. When we talk about the real estate sector in Las Vegas, what keeps it going higher and higher and higher? And this is going to illustrate for you the importance of the state of California, not just for Las Vegas or Nevada, but for the entirety of the nation. As California goes, so goes the nation. Since the pandemic, we have seen massive migration out of the state of California for various reasons. Higher taxes, higher crime, lower quality of living, lack of affordability for housing. A lot of Californians, knowing that they can work remotely, keep their jobs, but move to better quality homes, cheaper homes in other states. Among them, of course, the city of Las Vegas. So, for example, the neighborhood we call Summerlin here has become almost a California expat colony. You have all of these Californians with higher salaries, California salaries, living here, moved here, with higher purchasing power than the average Nevadan. And they have increased housing prices higher, to the point where now we have no supply. And that keeps home prices higher. And now they want to build the train that they've been talking about for decades now. The Biden administration wants to spend $6 billion to connect California to Nevada via train. Of course, when they say $6 billion, it's going to be $60 billion. That's inflationary, and that's going to exacerbate the phenomenon of remote working Californian workers out of the state. Here's the problem, though. What if all these remote workers who escape the state of California lose their jobs and they no longer have an incentive to live in their homes? They still have a mortgage that they cannot really afford anymore, and they can't find a job in their new community. If that happens, then we will see a massive reckoning in the real estate market, not just in the state of California and Nevada, but every other state, specifically the Sun Belt. We're talking about Arizona, we're talking about Nevada, Utah, Idaho, and of course, don't forget about the net migration out of the state of New York by remote workers over there, the smaller towns and cities and states around New York City. That real estate housing will also face a lot of trouble. Yet when we talk about California, it is usually a leading indicator for the nation, economically speaking. What we now know, after a couple of years of budget surplus because of the IPO mania in the stock market, now the state of California is in the hole. And it's in the hole big time. The headline reads, California faces a record $68 billion budget deficit. Now, what is the problem with that? Look at this. This is the biggest deficit since the GFC. Once we get a massive budget deficit like this in the state of California, usually, it is a leading indicator for a recession, not just in California, but nationwide. Here's the headline once again. California revenue decline is reminiscent of the Great Recession, new report says. So we see the parallels. But again, a lot of folks either lack of experience or just they decide to ignore it, even though they lived in those periods before. But now they're convinced that, oh, this time it's different, because fill in the blank. Reading from Bloomberg now, California is facing a deeper deficit than projected at the beginning of the year, as the fortunes of its wealthiest residents wane, exacerbating the fiscal situation of a state already struggling with tech layoffs and banking upheaval. For the first time since California Governor Gavin Newsom took office in 2019, the state's budget will swing into deficit, which he projected, listen to this, which he projected, Kim Jong-un Newsom, at $32 billion for the fiscal year starting July 1st. Instead, the hole is $9.3 billion, bigger than Newsom forecast in January, and reflects a sharp turnaround from the previous budget cycle, almost $100 billion surplus when the state reaped the benefits of headier economic times, aka the IPO mania. The expected shortfall poses significant hurdles for the second-term Democrat who's been traveling to Republican-led states to extol his commitment to liberal priorities such as green energy, subsidized child care, and social issues. And here's the problem, folks. You got a failed state, failed governor who's touring the country right now, bragging about his failures. It's amazing, really, the audacity of this guy. But how would California fix this problem? Here it is. Newsom, for instance, proposed pulling $450 million from the state's safety net reserve, about half of the money available, to reduce the need for cuts to spending on homeless programs, mental health, and substance abuse treatment, healthcare, and and other social programs that he said are critical for the state. Now, $450 million would do nothing. He will have to cut at some point, and cutting spending means construction for the homeless. All of these projects will have to be cut down. All of these benefits and the free yayo, courtesy of the taxpayer to anybody who asked for it, that's going to be cut down, and that's going to cause a lot of economic weakness in the state of California. And listen to this, some lawmakers are pushing Newsom to stave off cuts by tapping more of the state's $37.2 billion state reserve fund. Calls Newsom rejected on Friday. We are walking into a budget season where we need to maintain prudence, he said, warning, listen to this, warning that a recession could worsen the fiscal situation in the coming years. Wait a minute here. I thought we have a soft landing. Why is he talking about a recession now? You see what's going on here, folks? What is the importance of the state of California and the unemployment rate specifically to the rest of the nation? Here's the unemployment rate in California in blue, unemployment rate for the USA in red. Now, naturally, California has a higher unemployment rate because they give more benefits, they incentivize you being unemployed, so we see the unemployment rate going higher, more than the nation. Here's the problem, though. If we zoom in to the last episode, the GFC, right after the Fed decided to pause interest rate hikes, the unemployment rate in California was 4.9. The unemployment rate for the nation was 4.7. We fast forward. When the Fed decided to cut rates, the unemployment rate for the state of California have risen to 5.5%. The unemployment rate for the rest of the nation stayed the same at 4.7%. And then the rest is history. We all know what happened. California was the leading indicator for the rest of the nation. As California goes, so goes the nation. This time around, if we go back to August 22, the unemployment rate for the state of California was 3.8%. The unemployment rate for the rest of the nation was 3.7%. We fast forward to the present day, and the unemployment rate in California has risen from 3.8 to 4.8%, a full percentage point. The unemployment rate for the rest of the nation, it says here 3.9, but according to the latest report that we got on Friday, it's actually still 3.7. You see the parallels here. And if the unemployment rate in the state of California continues to go higher, it will be contagious. It will impact the rest of the nation. And since we talked about the jobs report, let's do a review here. And the discrepancies between the government's jobs data and the ADP report for the private sector is nothing short of stunning here. For example, the ADP report for the private sector of the economy shows a lot of weakness in hiring. We see job losses in many sectors of the economy, but the government's Cook data shows that everything is okay. We actually have a soft landing now. That's what they're talking about, soft landing. But they keep revising previous readings down by a lot, by tens of thousands of jobs every single time. So you take the unemployment rate with a grain of salt. But here's the catch, though. Notice the subheadline. Hiring moderated from earlier this year in recent months, with November gains boosted by return of striking auto workers. So this is really important to keep in mind because all in all, the November report is still below the average trend. So again, you see that the Fed right now not only reduced inflation, but reducing the pace of growth a little below average. But the job is not done. You gotta hold, you gotta see more weakening. Otherwise, you risk the phenomenon of reinflation. If you cut rates, if you say, okay, we're done here, it's going to backfire. When we look at different sectors of the economy, we see that healthcare is the strongest sector of the economy, bar none. I'm involved in the sector right now, and I can tell you from my experience that the demand is really hot. Hiring is difficult. You need to pay way above average wages. So I would say that the healthcare sector remains strong, will still be strong, even under a recession. Leisure and hospitality now, we've seen in the ADP report that leisure and hospitality actually lost jobs, and that's for the private sector of the economy. But maybe the government leisure and hospitality sector added jobs according to the cooks at the Bureau. Maybe that explains why Congress is always on vacation. But anyways, we see government jobs moving higher, construction moving a little higher, but according to the ADP, construction was actually down. The rest of the economy either negative or slightly positive. All in all, when we look at the trends here, healthcare, you can see that it's still strong. It's been strong. There's no problem in the healthcare sector here. Likewise, government, they keep spending like a drunken sailor. There's no problem here. Restaurants and bars was weaker earlier in the year, now firming up a little bit, but it's too early to say. Manufacturing, big drop last month because of the auto workers strike. Now some of them are back, so we see a big pop higher. All in all, net, we lost jobs in manufacturing. Information, a little bit of recovery here. Maybe some AI hiring, but it's been weak. Construction, one of the hottest sectors of the economy, is now also weakening. Professional and business services used to be strong, now becoming the weak. Retail lost a lot of jobs in November. Retail is a weak link in the economy. Weakening consumer demand combined with refinancing of retail real estate debt, dangerous combination. Something is going to break here. So let's do the icy hot phenomenon of this economy. And we start with the easy ones. In the hot category, we have healthcare and government. In the icy category, we have manufacturing, retail. The jobs data proves all of that. Transportation. If you look at trucking hiring, that has been collapsing. So transportation is the weak here. The icy. Autos. Demand for new cars, used cars is collapsing because of higher interest rates. We see that the CPI showing us that used and new cars prices are going down. So we know that autos are in the icy category. Now it's moving out of the hot category, closer to the icy category. Is construction. We see a lot of slowdowns in construction here. Leisure and hospitality. As the consumer demand weakens, we see these businesses facing a lot of troubles, and they will face a lot of trouble in 24. If consumer demand remains weak, they've hired a lot of employees with inflationary wages in the airline sector and cruises, hotels. They need to get rid of these employees, and that could push the unemployment rate significantly higher. Business services also used to be hot, now getting closer and closer to the icy category. What's moving out of the icy, closer to the hot, is dining. Used to be really slow in the summer. Now it's kind of heating up a little bit. Information, a tiny bit. A sign of life here. Maybe some AI hiring is my guess. But you can see that all in all, little by little, the economy is slipping into the icy altogether. And that's a big problem. But again, we have healthcare, we have government spending, which keeps a huge sector of the economy in the hot category, in the inflationary category. But all in all, this is what really matters to the markets right now. You see, the November rally was based upon mission accomplished, the Fed is done, they're not going to hike anymore. And what we should be expecting right now is rate cuts. We have anticipated a lot of rate cuts in 24. This is why the market has been rallying and we see bond yields going down. Question is, the market decided to play this game, the pivot game, 6 times. And 6 times in a row, the market was wrong fighting the Fed. This is the 7th time now. Would the market be proven right fighting the Fed, or would the market be proven wrong again fighting the Fed? We know that Mr. Powell, the chairman of the Fed, is about to speak this week, and he failed to tame expectations last time around. Now he has the last chance of the year to say, folks, we have made some gains here, we've made some progress, but the job is far from done. The risk of reinflation is still here. And you guys are out of your minds expecting a rate cut as soon as January or even March. He's not going to say that, but he's going to hint at it. He's going to try to talk us out of it, that you guys are going crazy right now. And probably because of the employment report that we got on Friday, we've already seen a lot of rate cuts being outpriced of the market, but not enough to upset the market right now. The deciding factor will be this week's CPI, PPI, and inflation report is always important to show us the degree of the progress. But of course, the commentary by Powell and the FOMC, I would think they will be more cautious than celebratory. And that could tame rate cut expectations by a lot this coming week. Look at what happened already. So the expectations for rate cuts in the month of January, on December 1st, were about 14.5%. After Friday, they went down to 4%. Expectations of keeping rates the same in the month of January. In November 10th, they were sitting at almost 78%. Now, holding rates for the month of January, the probability is at 94%. If we look at the month of March, on December 1st, the probability of a rate cut was sitting at above 55%, the majority. After Friday, those expectations went down to almost 44%. For the May meeting, expectations of keeping rates the same on December 1st were about only 10.5%, meaning the majority were expecting rate cuts. The probability for keeping rates the same by the month of May after Friday have risen to 41%. A stunning move here, from 10% to 41%. In other words, the market will find itself in an unfavorable position here, pricing in a lot of rate cuts and then all of a sudden having to price them out. And this is why we talked about this in Thursday's video, that volatility will spike. We talked about the gap between the MOVE index and the VIX. VIX goes down, MOVE going higher, defying the correlation. And this divergence will have to be resolved. We'll go over that again in the charts analysis, but we can also see that pricing in volatility in the next 2 weeks has also moved higher to the highest level since the collapse of SVB. These were earlier in December. Expectations 2 weeks from now for higher volatility. Why did they move higher? They know that we have a CPI report. They know that we have an FOMC meeting. And Jerome Powell of the Fed has the last chance of the year to say, folks, take it easy. Take it easy. We're not done here. You're going too crazy, and if you go too crazy, I'm going to have to punish you. I don't want to punish you because the economy cannot handle more punishment just for the sake of punishing you. But you're doing the economy a disfavor. We just went over all of these weaknesses in the economy, meaning that increasing rates at this point is not really something you want to do as the Fed. But if the market keeps fighting the Fed, are they going to force the Fed's hand just to raise rates for the sake of it and risk damaging the economy just to send the message? That's the risk that we have right now. I don't think the Fed will raise rates. I don't think they should right now. But I think that they have to be as firm as possible and as clear as possible to say that expectations of rate cuts as aggressive as the market has already priced in is insane. And you better hope that we're not going to cut rates as soon as you folks expect, because if that happens, it will only happen for the wrong reasons. I don't know if Mr. Powell is going to be as clear and concise as I just was, but he has to. He has to find a way. Of course, the man wants to speak with both sides of the mouth, not upsetting the market, but also hammering the message. And I would say, Mr. Powell, you got to speak with one side now. You speak with both sides, you got to run into a problem where the market will force your hand to take an action that you don't want to take and the economy cannot handle. Anyhow, folks, let's expand the conversation here and move on to the market coverage. We begin with the closing of the indices last Friday, and here we go. The indices, all in all, were fractionally higher. The diamonds by 130.49 points, or a gain of 0.36%. The Nasdaq in the green by 63.98 points, or a gain of 0.45%. The S&P 500 also positive by 18.78 points, or a gain of 0.41%. The Russell 2000 up by 1.41 points, or a gain of 0.76%. We look at the sectors on Friday. Energy leading the gains here with a rebound on Friday. We expect that energy will rebound a little bit here off oversold conditions in the commodity price. I'm not sure that the stocks will react positively though. The commodity might, but the individual stocks, we'll talk a little more in the heat map analysis because we have a lot of FTC problems here with the recent acquisitions. We also see in technology and financials leading the gains on Friday's session, the laggards, defensives, comm services, and utilities. We have no consistent theme here. Initially in the day, when we saw the dollar and bond yields going higher, the market actually pulled back. But then when we saw the dollar and yields stopping, then came the mechanics and options expiration, and we saw the market moving higher. For the week, all in all, we see that comm services at number one, thank you Google, and then we have technology, thank you Apple. But besides that, you have cyclical, financials, industrials positive, be it fractionally. And the laggards, led by energy, materials, that's going to be really sensitive to the rebound in the dollar. And defensives, we've seen some weakness because of earnings, Procter & Gamble. Then we got Dollar General, so we have some weakness in bigger names. That dragged the consumer defensive sector down. But you can see real estate used to be hot in the last couple of weeks, now going negative for the week. Is it a sign that yields, we're talking about bond yields here, will begin to rebound? What will be the catalyst? CPI, Jerome Powell? And if they rebound, we will see more selling here in real estate. If we look at the breadth all in all for Friday, pretty much closer to neutral here. NYSE 64% advancing versus 35% declining. The Nasdaq 54% advancing versus 43% declining. So on Friday's session, it was more of the value names, the rotation trade, not so much the big caps. But this week has been insane. One day the big caps are selling off, the next day they're being bought. So we see the rotation of the rotation of the rotation. And this is why we've said you got to stick with your conviction here. If you happen to be in the chase trade, meaning that you're in the big cap trade or the Ozempic mania trade, stick with those because they go down and come back up again. If you happen to be in the camp of the rotation trade, of the catch-up trade, of the IWM, other sectors that have been lagging, you got to stick to those too because they keep coming back. They go down a little bit when the big caps go higher, but then when big caps go down, we see them moving higher. Until this is resolved, the rotational aspect of the market, and maybe it's going to happen this week, you got to stick with your conviction here. Let's do some commodities here. On Friday, we saw a nice rebound in crude oil, but we have a lot of ground to make up here. Both the WTI and Brent were up by a little over 2%. Gasoline RBOB was up by about 3%. Heating oil, a rebound worth about 1.5%, but natural gas remains the weak link here, down about 1.25%. Now, what is the importance of this Venezuela-Guyana conflict that we see? Notice that both countries contributed to the lowering of prices of oil in the market. For example, the production by Guyana has been increasing dramatically throughout the year, but specifically in the month of October. So suppose Venezuela goes against Guyana here. You would say that the United States would probably interfere in favor of Guyana against Venezuela. I would say it wouldn't be that easy. Here's why. You look at the U.S. imports of Venezuelan crude, since the year 23. It's been exploding higher, and it's been one of the main reasons why we've seen crude oil prices going down in the year 23. If the war escalates, it will probably push crude oil prices higher. If the United States interferes and chooses one side or the other, understand that Venezuela have been helping the Biden administration by keeping prices at the pump lower, at least as low as they can. So it wouldn't be that easy, but it would be a catalyst for oil prices to go higher. When we look at softs, cocoa remains hot, yet another gain of about 2% on Friday. Cotton remains the weak, down about 1.25% on Friday. The rest are muted. We see a rebound in sugar here. It's been crashing, but sugar rebounded on Friday by about 1.5%. But keep an eye on lumber here. What is the importance of lumber? Recently, and again, this is not a historic or a reliable indicator, but recently, lumber futures have been projecting how the market is going to react. So you see that lumber tops at one point, then shortly thereafter, we see the market also topping. Lumber in green, SPX, S&P 500, in orange. We see lumber bottoming. Shortly thereafter, we see the market bottoming. Recently, we have seen lumber pulling back. Then we saw the S&P also pulling back. The problem is, Thursday into Friday, we saw lumber curling back down, the market going back up higher. That's a divergence. It's not the only one, though. I will show you more in the charts analysis. You'll be stunned here. So something is about to happen here. And I don't think it's going to be good for the market because it is defying not just one correlation, but multiple ones. We'll talk about them in a minute here. If we look at metals, the dollar rebounded, so we see gold, silver down, along with platinum. But then we see copper moving higher. So what's up with that? The dollar going higher, copper going higher too. It is part of the risk-on theme, copper, but we also got the news that China demand for copper is beginning to recover. Whether that story is going to hold or not under a rebounding dollar more than it did already, I think it has more to do. Will copper hold? That's what I want to see this week. We see decent gains here in meats, live cattle, feeder cattle, lean hogs futures, all up decently for the day. We look at grains down across the board, all eyes on wheat. Wheat has been a hot trade for the week. We identified that in the weekly chart that we have a breakout here, but it got a little too excessive in the daily chart, as we identified. So I'm not surprised to see a pullback in wheat here worth about 1.5% on Friday. But keep an eye, it could rebound really quickly here and resume the upward trend. When we look at the week all in all, again, you see that wheat is leading the pack here, with gains worth about 5% for the week. But all in all, commodities were down across the board, led by silver. Silver was down almost 10% for the week. Now, silver has the tendency of overreacting. It did to the upside when the dollar was going down, and now it's doing it to the downside as we see the dollar rebounding. But it means if the dollar stalls, it begins to go down because of this news that we got from the Bank of Japan, and the yen firming up at the expense of the dollar, that we could see big rebounds in silver here. But we have to look at the chart. We're going to do that in a little bit here. Moving on to the big casino, the options market, what do we see here? We got options expiration on Friday, so we see the volume recovering here, at least in the popular names, Tesla, AMD, Nvidia, Apple. And of course, they're buying more calls than puts, although the ratio improved a little bit. We were seeing 60s, 70s, even 80s calls versus puts, really excessive. Now we see some puts beginning to show up here later in the day on Friday. Maybe again, factoring in the expectations of higher volatility in the last 2 weeks of trading this year. I would, of course, keep an eye on AMD, a little excessive in the daily chart, but again, it has a lot of momentum now. I think AMD will continue to be hot. We'll do AMD versus Nvidia in a separate video. And of course, the Wall Street analysts, they're all locked in Nvidia right now. They got a little nervous when the news came out that AMD is now producing a chip that will go head-to-head against Nvidia. And their excuse is Nvidia is undervalued, but AMD is overvalued. Bullshit. If AMD just captures 10% of Nvidia's business, the valuations will be super cheap for AMD. On the other hand, Nvidia, if the growth begins to decelerate and the pricing power is eroded, then Nvidia is probably the most overvalued stock in history. But again, we'll do that analysis in a separate video. AMD versus Nvidia. Let's do the unusual activities that took place on Friday's session, and we begin with the ticker CAR. Now, look at the unusual activities here. Few cents here, couple of cents there. So that tells you that the market right now is a little hesitant. And sometimes, some periods of the stock market, folks, you're better off not trading at all. I think this is one of these periods where if you want to buy calls and chase some momentum, it's going to cost you a lot. And you need moves of 3, 4, 5% to make your money. If you buy puts, you might find them cheaper, but boy, if your timing is wrong, you're gonna pay for those dearly. So sometimes you're better off just holding, watching until the next trade is unlocked. We made a video this week, folks. For the members, I said bullish, right? That's what the market is doing right now. And what you need to see is the indicators. When all four of them get bullish or bearish, you want to trade. When they're mixed, as we see right now, you're better off holding your horses here. But anyhow, in any case, we begin with the ticker CAR for Avis Budget here. If you want to follow this trade, just be careful because the spread is really wide. But somebody sees the name moving higher. Perhaps a short squeeze, we'll see. They bought the 205 calls for the expiration date, December 22nd. The expectations, the name will rally higher by more than 8% by the expiration date. Paid about $1.50 a piece to enter this trade. All in all, spending about $1 million. And then we have the ticker IVV. Now this is the core S&P ETF. Why would somebody trade this one instead of the S&P, instead of the SPY? The answer is they shopped around and they figured out that the SPY is probably, the options at least, priced in a little too expensive. Levered indices, probably too expensive too. And they figured out that the best hedge here is to buy puts in the IVV because they found out cheaper options. It works the same way. Whether you're buying the SPY puts or the IVV doesn't matter. But here somebody bought the 435 puts for the expiration date, January 19th. The expectations that the IVV will go down and lose more than 6% of its value by then. Paid about $1.20 a piece to enter this trade, all in all spending about $900,000. And then what about the TQQs? This is the 3 times levered bullish index for the actual Qs, the NASDAQ. Again, maybe somebody wanted to chase some momentum here till the end of the year, but they figured out that Q calls a little too expensive, and they shopped around and figured out that the TQQs, the calls on this index here, probably offers the best deal. So they went with the 48 calls for the expiration date, December 29. The expectations, the name will go higher and gain more than 7% by then. They paid about 66 cents a piece to enter this trade, all in all spending about $300,000. On to the heat map on Friday. What do we see here? The answer is, it is lining up like a Christmas tree. You got green, you got red. There's no theme here. The big caps were hot on Friday, Meta, Apple, Microsoft, Nvidia, but then you got Google is the laggard beat. Google was up massively earlier on. So just pulling back here, we see some profit taking from Google. The chart doesn't look the best. We'll look at it in a minute here. And again, we see the same thing here that we talked about in the performance of the sectors earlier on. So you see financials in the green, energy in the green, defensives in the red, but notable individual names here. We talk about the Bank of Japan raising rates and firming up the yen. Would that be good for Japanese multinational companies or not? Short answer is, it's not going to be good. So we see TM, Toyota Motors, that went down on Friday. Likewise, another important theme. The dollar went higher, but copper keeps firming up on this Chinese demand story. So we see in metals, you see FCX, all copper went higher on Friday. Another name that I've been watching for a while now is BA in industrials, Boeing. Boy, that name has been hot. Big sell-off, which was a mistake, by the way. We talked about that the contracts are in China Air, Emirates, Riyadh Air. There's a lot of demand in the pipeline. And since then, Boeing did an impressive recovery. But is it becoming too overbought right now and due for a correction? We'll see. We have no sign yet, but I'm eyeing it. And by the way, as the sell-off in Boeing and McDonald's, a lot of the Ozempic-related names were a mistake, I would also assume that a lot of the overreaction that we've seen in yield-sensitive names such as REITs, such as home builders, such as regional banks, and even financials, the drop in bond yields is an overreaction, and that would be corrected in a big way. So the market provides you with opportunities both ways. Certain good stocks, they sell off for no good reason. That's an opportunity to buy. Certain stocks go way too high for no fundamental reason, just because yields went down a little bit from a trading perspective, not a fundamental perspective, and they overreact, and then they come down when the story changes. So keep an eye on those overreactions. They offer the best trading opportunities. If we look at the trading week all in all, what do we see here in the heat map? Any different? Of course, we see that energy was negative. We see that financials were a lot weaker, materials, industrials, healthcare, even certain names in tech such as Oracle, other AI names, CRM, Salesforce, other chips such as AMAT, Lam Research, Intel were all down for the week. So we had no specific theme here, but I would watch what the FTC will do here in certain names. So for example, you got Exxon was supposed to acquire Pioneer. I thought it was a mistake, and both stocks went down. Now the FTC wants to stop the deal. Then we got Chevron acquiring Hess Corporation. I said it was a big mistake. And they were betting in Guyana, by the way. That's where Hess is. That's going to blow up in their faces. So the FTC is doing Chevron a favor now. Likewise, AbbVie acquired 2 companies. At least that's the news. And AbbVie was up about 4% for the week. Will the FTC stop some of these deals? I think they'll do. At least they'll think about it. They'll announce something here. And you'll see a different reaction in AbbVie and in the stocks that went higher because of the news of the acquisition. Likewise, we have seen negative reactions in Cigna and Humana. We got a news of a merger. I thought it was a bad deal. You don't want to do these deals right now. When the economy is at the late stage, the late cycle, you don't want to do that right now. And of course, when they announced the merger, both Cigna and Humana went down. Now Cigna says, okay, we're not going to buy Humana. We're going to use the cash for buybacks instead. Now, what is that going to do? It's going to prop up Cigna's stock significantly higher. But understand that Cigna had a lot of weakness. They could have benefited from Humana in the long run. So if you're a long-term investor, you probably want to get the pump from Cigna here and then dump it later on. Likewise, we just got the news that somebody's going to acquire Macy's, the ticker M, so that's probably going to shoot up higher. Comes Monday, so we'll keep an eye on retail. Maybe it's going to fluff up speculation that the retail sector, we will see some M&A, some buying from private equity funds. We'll see. That could spice up the retail trade a little bit here. Anyhow, we'll look at the weekly heat map for the ETFs. What do we see here? Again, it was a muted week all in all. We have seen some overreactions. You see the TLT up, so you see yields were down all in all for the week. And again, while you see the DIYR real estate was muted, XLP defensives were muted, XLU also yield sensitive was muted to negative, XRT retail also yield sensitive was negative. You see that XHB and ITB, they have the tendency of way overreacting here. We talked about the concerns in the housing market. The problem with these names, be it DR Horton, Lennar, any home builder, they've overpaid for the material to build these homes. They paid inflationary prices. Now, can they sell these homes at higher prices? If we head into a recession and consumer demand weakens, the unemployment rate moves higher, then probably they're going to eat a massive bag here. So I think that there is a lot of overreaction in the home builders index here. And once yields rebound, specifically in the 30-year, you'll see a sharp overreaction to the downside. And I believe that that's going to be the case with the KRE, also yield sensitive here, regional banks. But then you got XBI Biotech. And I think that biotech is a lot more attractive. It is yield sensitive because we have high debt in this sector. But it already sold off and it has better fundamentals. So we see the XBI holding, and I think any sell-off in the XBI will be an opportunity to buy. Now, if you want to be specific and pick specific names and you have knowledge in the industry, go for it. But if you don't, just stick with the ETF here. And again, all in all, whether you look at large cap growth was positive, be it marginally, and then you got small caps also positive, but again, it's just a gain of about 1%. Mid caps were lagging, value was lagging, and in the negative side, we talked about energy, although I believe that energy is becoming oversold, due for a rebound, but then the majority of the weakness right now, not bond sensitive, but actually dollar sensitive, because the dollar rebounded more than bond yields this week. So again, when you look at dollar sensitive, we have gold miners, GDX was down big for the week. You have the SLV silver down big for the week, energy down big for the week. And of course, international markets led by Chinese equities, FXI, MCHI down big for the week. The FXI was down almost 5% for the week. So as the dollar firms, you're going to have these sectors facing a lot of trouble. And I think that yields will follow the path of the dollar this week. Speaking of, let's do some charts here. See what's going on. We have the SPY, the S&P 500 an hourly chart. What do we see here? We got somewhat of a trend line here since the beginning of the month. After a rejection at around 459.44, which is the previous high from the month of July. Comes Wednesday, we got a gap and cramp, and we lost this trend line. Matter of fact, we lost 456. I've been saying, not just this week, but for weeks now, the SPY is not going to reverse here until we lose and close below 453.58. That never happened. But I believe that Wednesday's session was a throw-off because if you look at the pattern here, it was a confirmation of a lower high. And I believe that a lot of folks, when they got the lower high, we lost 456, we lost the trend line. They began shorting. Then comes Thursday into Friday. They had to cover again, and the chart formed a higher high, closing above 459.44. Is this a throw-off to the upside as we got a throw-off to the downside? Who knows? It is possible if we get a reaction to the CPI, PPI, or Jerome Powell. Let's take a look at the daily chart, see if maybe we can see something different here. Again, we're a little bit above 459.44, closing above the July closing here. RSI is overbloated. MACD's losing momentum. The Vortex indicator is pointing out for a change of fortune here, where the bearish momentum takes over the bullish momentum. We got all of that, but the chart keeps grinding higher here without an excuse to sell. And so far, we haven't gotten a good excuse to sell here. So what we see instead, capitulation from the sideline, not a lot though, a marginal one. Enough to push the index a little bit higher here. Within range still, but a little bit higher here, since we have no excuse to sell. When we see these kind of moves, once we get an excuse, and again, the excuse will be, it's a no-brainer now. The market is pricing in rate cuts. Negate this assumption properly, reliably, not just Fed talk. Give us a piece of data that negates all of that. We got a little bit of it on Friday by the employment report. If the CPI comes out above expectations, that would seal the deal here and give the market the excuse to sell and retrace some of these gains. But absent of that, you're going to see the slow grinding higher because we have folks capitulating and the holders, they're not finding the excuse to sell right now. How high can we go if we continue to grind higher? We plug in the Bollinger Bands. If we go to the top here, that would be yet a gain of about, let's say, 0.75% from this point on. If we go down, we talked about in previous episodes, the fib supports. We talked about the 20 days moving average, but most importantly, we're not going to reverse the trend here until we close below 453.58. And again, if we clean up the chart, the importance of the 20 days moving average is every time we lost the 20 days moving average since July, we got a sell-off. When I say that you're better off not trading in certain days or certain setups, this is what I mean right now. If you want to chase the momentum, you're going to have to buy the calls at the top of the Bollinger Bands, overpay perhaps, and if the move doesn't happen in a timely manner or as big as the implied move requires because of these premiums really expensive, you're probably not going to make a lot chasing the move right now. If you buy the puts, your timing is wrong. The decay is going to kill you as we see the VIX going down. So why not wait for a reliable, solid evidence here of the better trade, which is, again, as a trader, you want to see not a continuation of the move, but the opposite move because options pricing. So if you buy the calls right now, they're expensive. The puts are not expensive, but you need to have your timing almost spot on here to flip these puts into profit really quickly. And losing the 20 days moving average will produce a bigger pullback with a confirmation. At that point, you want to fire up your trade. But if you trade in these zigzag and consolidation patterns, that's a recipe for disaster. You have to be really selective in individual stacks if you can see the opportunity. And again, you have to look at multiple indicators, not just one. So I'm highlighting for you last time around in September when we lost the 20 days moving average, that was one indicator, but the RSI was also in negative divergence. The MACD indicator was reversing from bullish to bearish. So was the Vortex indicator. So we had multiple indicators here giving us a signal that yes, we're going down. You have a trade here. Similarly, in October, we also got a breach below the 20 days moving average. That was a sign. The RSI was losing momentum, another sign. The Vortex indicator, bearish momentum, was firming up, bullish was going down. And of course, the MACD indicator was changing from bullish to bearish. So now we have multiple indicators giving us a high degree of confidence that if we trade here, we're going to be right. When we look at the indicators right now, the setup that we have right now, we don't have a breach below the 20 days moving average. So we have no signal here. The RSI is overbought, but it's not in negative divergence yet. The Vortex indicator not showing a signal that the bearish momentum has bottomed and it's moving higher. The bullish momentum is topping and moving down. We're getting close, but it's not showing it here. MACD indicator is the only one that's showing a loss in momentum from bullish to bearish. But again, the more indicators you put in, the more evidence you stack, the better your trade is going to be. And of course, on top of that, you have to look at the other indicators: dollar, bond yields, VIX, and crude oil. If we look at the weekly chart for the SPX, the cash index, what do we see here? Of course, we have the risk of the double top right now in case we go down this week. But absent of that, if we don't, then we have 4,637.30 as the next target here. If we clean up the chart, though, since we're talking about seasonality, folks talk about Santa Rally and all of that, you got to recall that recently the seasonality for the second half of December is not really that good. The majority of the Santa Rally actually happens from the month of October into November. So you see the trend in 21, in 22, and now again in 23. But after that, in the second half of December, in the year 21, we consolidated and went down. In the year 22, we went down and a pullback. In the year 23, what's going to happen here? If you follow the trend, we're going to get a pullback, and then we see what happens. If we look at the E-mini futures daily chart, what do we see here? You might see a big gap higher here, but again, this is the update of the contract. If you look at the actual March contract on the E-mini futures, you're not going to see a gap higher. If you look at the December contract, you're also not going to see a gap higher. So can we even look at this chart here, the E-mini futures? The only thing we can acknowledge here is that we're at the top of the Bollinger Bands, where we usually find resistance in a hard time to rally. But yet again, you look at the March or the December contract, there is no gap up here. But we watch the spot, we watch the E-mini futures as it is, and right now we have a gap higher. We've seen that before in September, we've seen it before in the summer, and we went down and closed all of these gaps before. And again, once we get to the top of the Bollinger Bands, we either find resistance or we reverse right away. So it's not a good point here for the E-mini futures to continue to rally impulsively. I think it's going to find a hard time to do so. If we look at the Qs, an hourly chart, what do we see here? And again, since the month of December, we got a gap and crap, then we formed a pattern of higher lows. On Wednesday, that pattern was broken. We got a gap to 390, big reversal candle, gap and crap, breaking trend, breaking 388. I believe a lot of folks, and again, if you're following the analysis, the technical analysis alone, you probably took a short in that, took a shot that the Qs will go down to 383. Then comes Thursday, you get a gap higher. Now what are you going to do? You're going to short cover. And I believe that that contributed to the pop in Thursday and Friday's session. What else do we see here? We see that we still haven't gotten the highs yet in the Qs. But our confirmation for a reversal would be closing below 388 and better yet closing below 383. If you look at the daily chart, for now we're holding on to the 20 days moving average. The chart retested that over and over and over again. It's been holding for now. It didn't go back to the highs yet, but the upside risk remains. If we go all the way up to the upper Bollinger Bands, that would be a gain of about 1% or so. The problem is if we get there, again, we have a reliable pattern here that once we get to the top of the Bollinger Bands, we either reverse or find it hard to rally and consolidate for a little while. What is the downside risk? If we lose the 20 days moving average, you got to do it the same way I'm doing. Stack up your indicators. Okay, so we lost the 20 days moving average. The MACD is reversing from bullish to bearish. Got it. Negative divergence on the RSI. Got it. The Vortex indicator showing signs of the bearish momentum taking over the bullish momentum. Got it. Now we have a better evidence to take the trade to the downside. Maybe all the way down to the lower Bollinger Bands, or use the Fibonacci retracement, bottom and top, and take your target from that point on. But you got to see some confirmation before you do that. If you're trading the weekly chart, the NDX, what do we see here? Again, you can see the reliability in predicting the bottoms using the Bollinger Bands in the weekly chart. Every time we got a breach below, we got a bottom. And this took place in October. Now, are the tops in the Bollinger Bands as reliable as the bottoms on the weekly chart? Not so much, but also we see the chart stalling, reversing, consolidating once it gets to the top of the Bollinger Bands in the weekly chart. For now, it is consolidating. It is hitting the top of the Bollinger Bands 2 weeks in a row, now forming a bull flag pattern until proven otherwise. Until we see a loss of the 20 days moving average on the daily chart, then we can talk about, okay, there's no bull flag here, got to the top of the Bollinger Bands, maybe forming what it looks like as a double top, and down we go. But again, you got to see something in the daily chart, and again, something in the hourly chart that will lead you to the daily chart, then to the weekly, that we have a sign of a reversal here. NQ, NASDAQ Futures daily chart, what do we see here? Again, you see the gap higher, but it is the update of the contract. I promise you, this did not take place on Friday. Look at the contracts for December or March, you see that the Qs is consolidating, not gapping higher. But again, if you want to take any significance from this chart, plug in your Bollinger Bands. We're at the top again. Either we're going to consolidate or reverse right away. You look at the IWM daily chart, which again, if you want to have any upside exposure, I go with the IWM versus the Qs because it is not overbought yet. It is the rotation trade which has or produces bigger gains than the chase trade. For now, we see that we have a closing above 186.49. We're consolidating in a bull flag pattern. The RSI is firming up, showing strength, not overbought yet. If we look at the weekly chart, what do we see here? Above the 20 weeks moving average, firming RSI, bullish momentum in the MACD soon enough in the Vortex indicator. So we have a lot of confirmations here. The IWM looks a lot better than the rest. And if we continue to go higher, we're probably going to reach 191.74. That would be a gain of about, let's say, 2.5%. And then we have the top of the Bollinger Bands in the weekly chart. Here's the problem though. The IWM is also yield sensitive. If bond yields rebound because PPI, CPI, Powell, it doesn't matter which factor it is, then it's going to be hard to see the IWM rallying higher. It would actually have a sharp reaction to the downside because of the impact of regional banks reversing. So keep that in mind. The Dixie daily chart, what do we see here? We got the support of Fibonacci. We formed the inverse in his shoulder. We're fighting the 20 days moving average right now. You look at the RSI, it is in positive divergence. You look at the MACD, it is in positive territory, bearish to bullish reversal. The Vortex indicator is about to prove that really soon. So we have a lot of good signs here, not to discount the dollar that's going to fade right away. It is holding into the fib support for now. So the assumption should be that the dollar will go higher, perhaps all the way to the top of the Bollinger Band. If you look at the weekly chart, again, we got a bottoming signal, then we have a confirmation for now, but the ultimate confirmation will be the dollar closing on weekly basis above the 20 moving average. Otherwise, it's going to be a rebound in what could be an inverse ABC pattern. In the meantime, as the dollar rebounds, what do we see in the old man gold? What we see is, as we talked about, hold your horses. Everybody wants to jump in and chase gold right now. If you missed it, you gotta get a better opportunity. We got a bear flag, we got down to the 20 days moving average. Maybe we'll do a little more. Look at this chart, folks. The RSI is in negative divergence. The MACD is showing bullish to bearish reversal. We're about to lose the 20 days moving average. The vortex indicator is showing bearish momentum firming up, bullish momentum losing some ground here in the blue line. So you want to give it a little more time before you hop in. With the weekly chart of gold, what do we see here? We did the ABC pattern. We got to the top and outside of the Bollinger Bands, and we said we're going to have a reversal here. We got it. Can we go a little more to the downside, to the 20 weeks moving average, and then find support there? I would not be surprised. And this is why I say that you can afford to wait a little more here for a better confirmation. GDX gold miners, what do we see here? We got down to the 20 days moving average. That's going to be support number one. If we lose it, then we have more downside to come, probably closing the gap in or around 28.5. RSI losing momentum, MACD losing momentum. So is the vortex indicator. So again, you look at the charts from different ways. GDX doesn't look as good as the dollar. So I think the dollar does a little more rebounding. We see gold and silver going down a little more. Speaking of, here it is, silver, SLV. What do we see here? What we see is we lost the 20 days moving average. We lost 21.43. The volume is increasing in the sell-off here. The RSI is in negative momentum. So is the MACD. So is the vortex. So we have a lot of confirmations that this is downside momentum right now for silver. Once the dollar is done rebounding, silver will find a bottom and recover nicely. But for now, you got to hold your horses, otherwise you'll be catching a falling knife. UK oil, what do we see here in Brent oil? We see that we're outside of the Bollinger Bands. We're getting really oversold here. RSI is oversold, reversing some momentum. No confirmation in the MACD or the vortex yet, but again, the risk versus reward says that we're probably going to rebound a little more, specifically if we pass the open of the breakdown candle that you see in the yellow line there. If we do it, then we have more gains to come, perhaps a retracement to the 20 days moving average. Does that mean that you buy oil stocks? The problem is with stocks is if we see the equities market selling off altogether, probably energy stocks will go down too. So I sold a lot of my energy exposure and I'm sticking to the commodity here, the spot price in UK oil, the weekly chart. You can see reliably that once we get outside of the Bollinger Band like this, we have a rebound coming. For now, we're anticipating a rebound, not a bullish story here. Just a rebound trade for now. And again, since we got rid of oil stocks, we're sticking with the USO, the spot price here. Look at the daily chart. We got outside the Bollinger Bands, became really oversold. We got a rebound Friday, took a trade on it. I think we have more juice to squeeze here, maybe to closing the gap or reclaiming even 69.5 and retracing the 20 days moving average. So for now, we're going to stick with that call until proven otherwise. The 2-year yield, what do we see here? Look at this. This is what the market completely ignored on Friday's session. Big pop high. Outside of the consolidation range. We talked about how it became really oversold outside of the Bollinger Bands, RSI, yada yada. Now we're getting a rebound. We're probably going to face some resistance here in the 20 days moving average in or around 4.785 basis points. If we pass, we have more gains to come. And Mr. Powell of the Fed has more control over the 2-year than this guy right here, the 10-year. Although the 10-year rebounded on Friday, but it's not as strong as the 2. To freak out the market, you need to see the oomph of the rebound, and so far we did not get it. We got a wedge, we broke above it, I believe 2 weeks ago, but that was short-lived. Now we have another wedge. We got a break outside, good to go. Okay, got it. RSI firming up, MACD firming up, but you got to see more. You got to see a crack above the 20 days moving average, threatening to reach 4.5. If you threaten to go to 4.5, then the market will begin to freak out here, that oh my God, rate cuts, probably not going to happen as soon as we anticipate. Now in the 30-year bond, what do we see here? The yield, of course. Got really oversold outside of the Bollinger Bands. Got a rebound. Faced the Fibonacci resistance here. But we need to see more. You need to see the 30-year also above 4.4% into 4.5% before you begin to see the market freaking out, specifically the home builders and real estate. And that might happen this week. We have a lot of catalysts here. And this is why we made a call in the TBT after it got really oversold outside of the Bollinger Band in the daily chart to take a shot and buy some calls here. Paid off on Friday. We're going to stick with it a little more here into the CPI, maybe a little more into Jerome Powell. And if you don't like the calls on the TBT because of the reset every day, because this is a levered index, you can buy the puts in the TLT. It's the same thing. So you look at your indicators on the TLT. You're outside of the Bollinger Band, so you got a check mark there. The RSI got overbought. Now it's in negative divergence. You got a check mark there. Your vortex indicator is changing. You see the bullish momentum topping, curling down, bearish momentum curling and moving higher out of bottoming. It's a good sign. MACD looks toppy, but not reversing yet, but it's a good sign that we could see all of these indicators aligning rebounding and giving us more downside in the TLT here as we see bond yields recovering. It doesn't say that the TLT is going to go down to the lows again, but it says that after an impressive rally, you got to stop and take a breather here. And again, a reminder, since we talked about lumber and the stock market and how recently we have a defiance in the correlation, look at what's going on here. TLT in green, daily chart, SPX in orange, also daily chart. They trade together, folks. We talked about the divergence in the summer when the TLT was going down, meaning bonds going down, but the equities market was going higher. We said that this is not sustainable here. Next thing you know, equities market followed the lead by the TLT. We only defied the correlation because of the AI mania in NVIDIA. But then soon enough, we got to our senses and we followed the bond market. Now we see bonds rebounding, so yields going down, bond prices are rebounding, equities market also rebounding. Look at what happened here recently. TLT down, SPX went up higher. So that is a divergence here that remains unexplained. Maybe it's going to be explained this week. After a catalyst such as the CPI, PPI, Jerome Powell, bonds go down, TLT, SPX follows, then we're back into correlation again. VIX, fear index. What do we see here in the daily chart? Again, rejection after rejection of the 20 days moving average here, and the VIX is now at the lows since the pandemic. Complacency, sure, but it also means the puts are getting really, really cheap here. Hedging becomes advisable, at least, heading into the PPI, CPI, and Jerome Powell. And maybe betting to the downside would be advisable too. But again, the more confirmations you see of bond yields rebounding more, dollar rebounding more, crude moving higher, VIX recovering, and it might do it this week, but also your individual indicators, such as the 20 days moving average, MACD, RSI, Vortex, the more evidence you stack, the better shot you have at a successful trade, rather than just following one indicator. So here, in the VIX, daily chart, the VIX in green, and the MOVE index, the volatility index by Bank of America, bond volatility, in orange. Clear correlation? Got it. But now we see divergence. MOV moving higher, VIX moving down. Will the VIX catch up with the MOVE index? If it does, then we have a pop coming. We know what the catalyst would be. A market, your expectations of rate cuts are a little premature here. You're going to have to price them out. And the VIX goes higher, following the MOV index, the volatility for bonds. Apple, the big kahuna, daily chart, what do we see here? Again, it is facing the upper Bollinger Bands. You see how we got rejected once, twice. Now we're fighting, squeezing our way to expand the Bollinger Bands. Do we have confirmations here? Are we below the 20 days moving average? Not really. Is the MACD now changing from bearish to bullish or bullish to bearish? We got a bullish to bearish, but now it's not as clear as it was before. RSI is still firming up. It's not a negative divergence. And the Vortex indicator not giving us a clear sign here. So Apple right now is the strongest link in the big caps, because you look at Microsoft, that one is below the 20 days moving average. So we got a check mark here. But again, we're fighting with the 20 right now. We don't have a give up, a rejection, forming an ABC pattern, for example. The MACD indicator is giving us confirmation, RSI a little bit, Vortex finding it. So we have better confirmations in Microsoft versus Apple, but you'd like to see the give up from the 20 days moving average. Right now it's fighting. It wants to climb above. If it fails by an engulfing candle to the downside, then you got a momentum trade here to follow. You look at the weekly chart for Microsoft, what do we have here? Got a topping signal here from the candle that we got last week. It was outside of the Bollinger Bands. 3 weeks in a row, which is quite unusual here. And now we're below. So what do we do at this point? Look at our indicators here. Stack them up. We got a topping candle. RSI is still firming up. It's not really giving up here. Vortex showing a little bit of a change here, but the MACD is not giving us confirmation. So for now, we have good signs that maybe we're topping here in Microsoft, but no confirmations yet. So the recency bias becomes stronger until you give up the 20 days moving average. Then you'll see these indicators improving to the downside. GOOGL, Google. What do we see here in the boss? They own this channel, so we have to be careful here. On the daily chart, we talked about this trend line. It was support, now it is resistance, and we got a gap higher because of some AI pump, but it stopped exactly at the trend line here and add the resistance that we identified before in or around 138. We clean up the chart a little more. We use the Bollinger Bands, 20 days moving average. We're still above, not below. So we got no confirmation that way. And if we trade like this and keep these highs at a lower high and we lose the 20 days moving average, then the next support would be in or around this pattern that you see right now. Higher lows, lower highs, triangular pattern, which will also coincide with the lower Bollinger Bands. And that will be in or around 129 to 130. But you got to lose the 20 days moving average and then take the shot. NVIDIA, what do we see here in the daily chart? We went down, bear flag played out, we lost the 20 days moving average. That got us all the way down to the lower Bollinger Bands. We found support. We got above 464.25 again. The lower Bollinger Bands kept us a support even as we went down in the big red engulfing candle. And now NVIDIA is working its way to challenge the 20 days moving average. If it fails and then loses the support line of 464.25, then we can take another shot at it and short it all the way down to another target. What would that target be? Here it is, the weekly chart for NVIDIA. So we got the 20 weeks moving average as support right now. If we lose that and we fail to reclaim the 20 days moving average, days, not weeks, days moving average, and then we lose the weeks moving average at 451.24, then we got a confirmation for a trade all the way down to the lower weekly Bollinger Bands. That would be in or around 400. On the other hand, you got to be aware about the upside risk here in the weekly chart. This could be an A, B, C pattern. We got an A leg, got us all the way to the upper Bollinger Bands, B leg all the way down to the 20 weeks moving average, and then we get a C leg all the way to a new high. So that's your upside risk. You got to be aware of it. The downside risk, once again, we go down to the lower Bollinger Bands. That would be a loss of about 15.5% from here. But you got to wait for your confirmations. AMD, since AMD is moving higher, daily chart again, got a little too excessive here outside of the Bollinger Band, so it is finding a hard time to rally. Doesn't mean that the chart is bad. You look at the weekly chart. Again, it got a little too high here, so it's going to find a hard time to rally. But you look at the RSI firming up, MACD firming up, from bearish to bullish momentum. So is the Vortex indicator. So I believe in the weekly chart, if the momentum here continues in AMD, we're probably going to go to 132.83, the previous high for this year. And if we break above, we'll see more buying here in AMD. It is the opportunity if it managed to steal just a fraction of NVIDIA's revenue. Now, if it is a momentum rally, we can expand the Bollinger Bands higher. We have seen this twice before, one in 21, another one earlier this year. So we could see an impulsive rally here in AMD. The chart looks similar. It is a possibility. And lastly, BTC, Bitcoin, tulips, what do we see here? And I took this shot last night, so I'm looking at it right now. There is no significant update. All what we see is consolidation at the upper Bollinger Bands, as we've seen before, and the consolidation usually leads to more gains. So the RSI is overbought, the indicators are a little hot, but BTC is taking a breather here to gather more energy and then pop higher. Until what? Until the sellers show up. Now, why would the sellers show up? We'll talk about that in a minute here. But look at the weekly chart for BTC. Overbought, outside of the Bollinger Bands, we got it. So we know that the rally is getting a little hot here, excessive. But look at the past example here. If the mania wants to continue, it can get really, really hot. You'll see pullbacks, really sharp ones along the way. But if the momentum is behind it, it can go really crazy. So what are we looking for here when we say if the sellers show up, the rally stops? Is there a correlation between Bitcoin and the 10-year yield, for example, or the dollar for that matter? Well, here we got Bitcoin, weekly chart in green. We got the dollar in blue. We got the 10-year in orange. As you can see, there is no correlation. Bitcoin is its own animal. It doesn't really care about the dollar. It doesn't really care about the 10-year yield. Now, you might say, but Maverick, it is correlated with gold. It is the digital gold. Here's gold for you in orange. Weekly chart again, doesn't look like we have any correlation here. Maybe a little bit from time to time, but it's not a spot-on correlation here. Better than the dollar in the 10-year, but not spot on. So here's the mystery for you. What moves Bitcoin? The answer is sentiment. So when the sentiment becomes really bullish, as we see right now, Bitcoin advances. Here's Bitcoin in green and the ticker BUZZ, the momentum ETF in orange. As you can see here, we have much better correlation. In other words, Bitcoin is a tulip. It's a speculative asset. It moves higher when we have higher sentiment. It moves down when we have lower sentiment. As simple as that. If the retail crowd is excited, we see Bitcoin going higher. If they're feeling bad and low, we see Bitcoin going down. So it is a sentiment indicator. That's what Bitcoin is right now. So if the sentiment becomes even more excessive, can we discount that Bitcoin's not going to rally higher? I can't say that. If sentiment changes because CPI, PPI, Powell, Middle East, aliens, whatever factor it is, then Bitcoin goes down and the sellers show up. Anyhow, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, the 11th, we got nothing, so it could be a good day for the market to continue to grind higher with no resistance at all. Tuesday, December 12th, we have the big one, CPI, aka CPLI, will be really important because expectations are really low. So we got 3% year on year, core CPI, 0.3%. If we beat those just by a tiny bit, it pushes rate cuts further down the line, and the market has to reprice. Then Wednesday, 13th, we have the PPI, Producer Price Index. We have the interest rate decision by Mr. Powell and company. And then, of course, the presser. We'll cover it live here, folks. And then we got Thursday, 14th. This is going to be a heavy macro week. CPI, PPI, Powell. On Thursday, we got initial jobless claims, import price index, retail sales will be really important here. And finally, Friday, December 15th, we have Empire State Manufacturing Survey, industrial production, along with capacity utilization. But the most important event for Friday would be OPEX. What a week. It couldn't be more exciting than this, folks. We'll be here. We'll cover it live, day by day, minute by minute. So if you want to join us, become a member, you got the join button. Click, try it, you like it, stay, you don't like it, no harm done. If you did like this video and found it informative, please help us out here. Press the like button, subscribe, leave a comment. You know the deal. With that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.